Stocks fell on Wall Street and added to weekly losses for major indexes. This comes as central banks around the world hike interest rates to fight inflation. The S&P 500 slipped 0.6% on Thursday. The Dow Jones Industrial Average and the Nasdaq also fell. Central banks in Europe and Asia raised interest rates a day after the Federal Reserve made another big rate hike, and it signaled that more were on the way. The goal is to cool down economies by making it more expensive to borrow money. Meanwhile, investors continue to deal with the fluctuating market amid inflation and interest rate hikes. Well, joining us now to give us his outlook on the markets at this time is Brendan Caldwell, director of Caldwell Securities Ltd. Brendan, welcome back.
Thank you, Nima. Great to be here.
Now, it's not all bad news on the stock markets. We know technology stocks are bouncing back after a major sell-off earlier in the year. So do you think this is the end of the downward spiral for them, or maybe just the beginning?
Yes, I think both. I think there's going to be a bifurcation, a split between technology stocks that deliver the goods and those that are just fluff and air. It'll be harder to tell what a technology stock is in the future as more and more companies adopt the technology. I mean, if everybody's a technology stock, perhaps nobody is. But those traditional, if you can say that, names like Microsoft and Apple that have both earnings and dividends to back them up, I think we'll continue to go from strength to strength, even if in the short term the market is volatile. Whereas companies where they are trading at very large multiples to either current earnings or in many cases the hope of future earnings, I think they're going to have a harder time for longer in a higher interest rate world.
Now, meanwhile, these continual interest rate hikes have made bond returns competitive with stocks. So what does this mean for investment portfolios, Brendan?
Well, bonds have not been a great investment for a long period of time, for at least not for the individual investor, because you look at a bond, you can say we're getting 1 or 2%. Now investors look at bonds and say, well, I could get maybe 4%. Well, that's really good. Now, it takes a long time for people to adjust to the new reality. And while interest rates have gone from 1 or 2 to 3 or 4 or more, inflation, as we've seen, has gone to 7 or 8%. So when interest rates were down at 1 or 2, inflation was there too. But now inflation is at a big premium, or almost double in some cases, to where interest rates are. But investors are still going to be looking for those higher rates. So, 4%. Oh, that looks great. Let's give me some of that. I think the key will be to be in not so much fixed income, but income streams that have the capability of growing. Because I do not think, despite the central bank's best efforts to raise rates to slow down inflation, that inflation is slowing down anytime, particularly soon.
All right, Brendan. Well, with higher rates and potentially slowing economy, how will companies grow their dividends?
Well, it's an interesting time right now, because the entire 30 years I've been in the investment business, companies have not really had pricing power. They have not been able to ratchet up their what they charge the consumer. The only way they could the only way they could increase their profit margins was to cut costs. So to be able to get some traction on the pricing side, I think that will be helpful because they can say supply chain, they can say inflation. I think consumers are more willing to accept higher prices, especially in an era where there's a shortage. So I think that's going to be helpful. I think dividends are going to be key, because they will be the increasing revenue stream that I think that even though you've got a company that's got 2 or 3% dividends, you think, well, maybe I should buy a bond that has a 4% interest rate. But those 2 or 3% dividends, if they are able to grow over time, will look an awful lot better longer term.
All right, Brendan, about a minute left here, but what is your overall outlook for the markets during inflation and interest rate hikes?
Well, I think that there will continue to be a lot of volatility, because more like what we've seen this year, this market is not at all certain. But all that's known is largely priced into the markets. We think that interest rates are going to continue to go higher. We think that central banks are going to continue to raise rates. And the markets are where they are. So if we got any good news, if there was a resolution, a reasonable resolution to the war in Ukraine, if inflation numbers looked more tame than what's being projected or what we're seeing right now, if a shred of good news would actually, I think, give the market an unexpected lift. So I am cautiously optimistic, and I do think investors, rather than sitting entirely on the sidelines, as you and I have discussed over a number of weeks, should begin to do something and take advantage of this volatility by adding over a period of time, because I think that's going to give them the best return.
Always helpful interviews. Brendan, thank you again for your time today on Forum Daily.
Thank you, Nima.